Hi guys, here's Hustle Hub. Today we're going to talk about private equity. If you ever watched Bloomberg, CNBC, or any other program talking about the markets, you probably heard about private equity and private equity funds. But what are they exactly? And do they differ from other funds? When you talk about investment funds, you have to divide them between those who invest in public equities and those that invest in private. Public equities are those that can be bought and sold on a public exchange. These can be public companies traded on the stock market, state and municipal bonds, and any other asset listed on an exchange. Private equity invests in assets that are not traded on a public exchange. These can be companies that are not listed on the stock market, real estate, from developments to commercial and industrial real estate. They also invest in bonds of companies that are not selling them on the market directly. Lately, private equity funds have also invested in startups in their late stages of fundraising. An example is the Carlyle Group that invested in Beats by Dr Dre before it was acquired by Apple. And we have already covered the story of David Rubenstein, co-founder of the Carlyle Group, so make sure to check it out. These companies raise funds mainly from institutional investors, like pension funds, and lately they have been relying more and more on sovereign funds, mainly coming from the Middle East. In the last years, the number of billionaires coming from private equity has risen significantly. Let's name some private equity firms. For example, Blackstone, the Carlyle Group, KKR, Apollo Management, Silver Lake Partners, TPG, Vista Equity Partners. They all have billionaire funders, and this is just in the US, without counting the venture funds that are sub-part of private equity. But why is this industry so lucrative, even though it hasn't grown like technology? One of the key elements that made this sector so important is the outcome of the 2007 and 2008 crisis. In order to bring growth back, the central banks had to bring the interest rates close to zero and even negative for some time. This made it extremely hard to have returns on investment in the bond markets. And this led to the stock market heating up as well, and dividends on stocks decreased as a consequence of the price multiples increasing. Here we're talking about the price-earning ratio. Let's make an example. If the stock trades at $100 and pays $2 in dividends, it pays 2%. But when the capital that used to stay in the bonds market goes into the stock market and the stock price goes to $200, but the dividend is still $2, the rate goes from 2% to 1%. So institutional investors started looking for assets with higher returns. Given the fact that private equity makes alternative investments, such as not listed companies and real estate, it became easier to have returns in private markets. That's why private equity funds were able to raise so much capital from pension and sovereign funds. For example, Blackstone raised $20 billion from Saudi Arabia Public Fund in one single round in 2018 and continued to raise in 2019. Many other funds received capital from the Middle East, like the Carlyle Group. Thank you guys for watching the video, and remember to give us all your support by subscribing to the channel, smashing the like button and turning on the notification bell. See you next time with another video for you. This is Hustle Hub.